Everyone has to live somewhere, and everyone has to invest their money someplace. So what happens when where you live meets up with where your money is invested? Hello, real estate. Hey, everybody. Welcome back to Big Money Real Estate. I'm Elise Link. Here's today's update. Fannie Mae just published its monthly housing and economic outlook for August, now that we're in September, and it includes a bit of a cautionary note about the flat second quarter growth we saw in the economy. That doesn't seem to have affected Fannie Mae's prediction for the year's growth overall. And with regards to housing in particular, the outlook remains pretty optimistic. The report takes note of strong home price appreciation and tight inventory controls, which are great for homeowners, not so good for first-time home buyers. So I'm excited to have Fannie Mae's chief economist, Doug Duncan, on the phone with me today to talk about the latest data, and who knows, maybe we'll even talk a little bit about the stock market craziness. Welcome to the show, Doug.
Thank you. Glad to be here.
So the world over the last couple of weeks, if you just look at the stock market, you'd think that we were heading for some sort of 2008 all over again, and yet federal government's numbers made the first quarter look pretty terrific and essentially offset what we saw was quasi-negative, maybe down a little bit or up a little bit, or maybe just flat growth in Q1. And in Q2, we see it zooming ahead. So what's your take on that?
Yeah, there's no question the first half ended up being reasonable. And we think this second half will be pretty similar to the first half. So it's growth. That's good news. The underlying best part of that story is continued strong job growth, which, of course, in the housing industry, that's something we focus on a lot. We're hoping to see real income growth pick up. That's the other leg that has to get put in place before you'll start to see a really robust housing market. Nonetheless, housing is actually doing pretty well in the midst of this. We're not back to normal. You referenced a couple of points that we can talk about in terms of supply and the strength of house price growth, but not bad.
Well, that's so lukewarm. I've heard you, listen, over the years, I've heard you be really gung-ho about growth. And first of all, we should just
probably an adjustment of expectations, right? I mean, we haven't normally, when you come out of a recession, particularly a severe recession, you see real strong growth for a couple of years, well above long-term averages, and we never saw that.
No.
So we're really still below a mark where we should be.
Well, the numbers this year for new construction look still like they're going to be about 500,000, which is roughly half of where it should be. Wouldn't you agree? That's kind of not good, right?
Yeah, the big story in the housing market in general is the lack of supply growth for single-family homes. The apartment market is doing quite well, and construction there has ramped up, as you would expect to see after the kind of a downturn that we had, and it will probably continue to be strong for a while. But the real missing element is the supply of single-family properties, particularly at the lower and middle price points. So part of the reason you're seeing what is very strong real house price growth is the lack of supply. Even though the demand side of the equation isn't going gangbusters, it's growing, but given the pace at which it's growing, you would expect to see actually a lower real house price growth.
So there's more profit in the higher end stuff. And we're seeing builders, sort of the mom and pop builders who were a mainstay of creating that kind of low to moderate income new housing product, let's call it. A lot of them lost their companies in the recession. The land went back to the builders turned around. We actually saw two of the biggest new construction companies, Pulte and who did they merge with? Centex, right? They merged. And now you've got Toll Brothers focusing on very high-end stuff. You've got the remaining home builders focusing on where the profit is. But you're also, to your point about unemployment, there's just so many people left the house creation market. I'm hearing from builders and from other economists that it's very, very difficult for people to find people who actually know how to do drywall, moldings, painting, and getting them in any kind of steady supply is tough for them as well. And when you can find them, they want a lot of money for the job.
Yeah, I asked Bill at the National Federation, Bill Dunkelberg at the National Federation of Independent Business, to take a look at his survey of small construction businesses over the last 20 years or so and asked what's the average share of them that say they have a hard time finding workers. And he said it's about 5%. So I asked him, what's the share today that's saying that? And he said it's 21%. So that's one piece of evidence. Your point on wages, if you look at the federal data on real wages in construction, they're roughly at the same level they were at the peak of the boom. So clearly the market is signaling for that there is strong demand for construction labor and it can't be identified. A second factor that we're investigating, I don't know the fact of this yet, but some of those small contractors have historically done one of two things. Either they've taken lines of credit under the acquisition, development, and construction loan type from their local bank, or they've tapped equity in their home for working capital for their building activities for speculative building. The regulators have clamped down on ADC lending because of the losses that occurred in the crisis, and in many instances, it may be the case that some of those smaller contractors saw their house price fall and can't tap equity in their home either. So credit could be an issue. And then the third issue is simply the availability and difficulty of permitting land. It seems as though across the country, one of the responses to the crisis was a sort of systematic tightening of regulation related to the development of residential real estate properties.
Well, permitting has always been tough, and I think there's a lot of not in my backyard NIMBY sort of activity that goes on, and people have gotten, very aggressive in that. And then you've got on the West Coast a whole lot of community stuff going on where people are tattling on their neighbors for water usage and things like that. It's not exactly so friendly for growth. So, Doug, let's talk for a minute about Fannie Mae's full-year growth outlook. You've got it unchanged at 2.1%. It's interesting. We were at basically zero growth in the first quarter. We had 3+% growth second quarter and a revision look. Where do you think we're going in third and fourth quarter to get back to that 2% average level? Do you think we're going to go down, or do you think we're going to go up?
I think it'll be right at the 2 to 2.25% growth average in the second half. So that's why our forecast says, I think, 2.1% for the full year. So we'll be just a little bit above that. The first half was just a little bit below that. It's tepid growth. That's not the kind of growth that generates a great deal of excitement economically. And to your point about housing, yeah, it's better, but demographically appropriate level of total housing starts would be about 1.5 million. We might be at 1.15 million. So we're still a ways away from normal, if that would be your measure of how we get to normal. Nonetheless, housing will contribute more this year than it has contributed each of the past years since the recovery started. So it's on the right path, but we still have a ways to go.
All right. And then finally, the stock market down about 300-400 points today. We've seen really just getting hammered by China, day in and day out. So let's, if you don't mind, let's talk for a moment about China. And China's where so much manufacturing is going on now for the U.S. housing industry, although I don't know after what happened with drywall if we'll be buying so much Chinese drywall. But what's your perspective sort of on China, Greece, and this kind of global unease that seems to be settling over the economic world, or from an economic perspective, and how you think that might affect us going forward over the next year?
Well, there's no question that China's economic growth is slowing. The question related to that is how much. Nobody really knows for sure. It's difficult to understand just how accurate their economic reporting is, but you can tell by looking at the commodity prices around the globe that they are slowing because they were the marginal buyer in almost every commodity market, and we've seen them slow systematically. So that is having an impact on those particularly intensive and where they were selling commodities to China for its infrastructure and internal investment development. China's made no bones about the fact that they ultimately have to rebalance between investment and consumption, but that's not an easy task, and particularly in a command economy. Theirs is not a market economy in the sense that ours is. They've moved somewhat in that direction, But as you can see in their reactions to the turmoil in their stock market in the last month or so, it's a very different thing to try to generate stability in a managed market as opposed to a market-oriented economy. In Greece, essentially, they've kicked the can down the road another 3 years or so. So that in the near term is not going to be a big story. The question is whether or not the EU in general will, with their quantitative easing, start to see some growth. We will await that. From the U.S. perspective, our biggest trading partners are Canada and Mexico, and both of them are doing okay. Canada is suffering from the decline in oil prices, so that's actually slowing them more than it's slowing us, although it has had somewhat of a tamping down effect on us through the investment side of things. Mexico is doing fine. And the amount of trade we actually do as a share of our total trade with China is pretty small. I think I saw most recent numbers, something on the order of 6%. So it's actually quite small, even though it gets a lot of coverage. They're a larger, more important trading partner in Southeast Asia. Those countries are likely to suffer more from the slowdown of China than we are, and also places like Brazil, which are resource intensive.
And all the rest. All right. Well, Doug, thank you so much for joining me today. That's, as always, really enlightening. Doug Duncan is Chief Economist for Fannie Mae.
Thank you. Glad to be there.
We'll definitely check back with you again soon. And thank you for watching this episode of Big Money Real Estate. As always, you can send me your real estate or personal finance questions on Twitter or Facebook, and please share this video with everyone on social media. Don't forget to check out my brand new series, The Intentional Investor, How to Be Wildly Successful in Real Estate at thinklinkstore.com. See you next time. I'm Elise Gling.